Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. This is our weekly live Q&A where for about 2 hours, if I can manage it, if I can survive, I do my best to answer your questions in the chat. So if you are in the chat, please give me a thumbs up that you can hear me. By the way, I have a phenomenal retirement calculator to show you today that a viewer named Dan, I don't know if it's Dan the spreadsheet man, if it's Dan who created the investment spreadsheet. But in any event, Freebird0147, thanks for the thumbs up. Bill, thank you. By the way, Tom F., I see your question. I will get to it in a minute, but it helps me if you can tag me in any questions you want me to address or topics you want me to cover, because it shows up bright orange. And then I can just skip over all the other banter back and forth. I'm going to show you the calculator in just a minute. I've made a change to how I'm handling comments that I want to mention. I first didn't know a thing about YouTube, just people commented, but the spam is just really bothers me. And by spam, I don't mean a silly comment. I don't consider that spam. I consider that a silly comment. And I certainly don't mean comments that disagree with me. What fun would that be, deleting those comments? Those are, in fact, some of my favorites. I'm not kidding. But it's where people try to imitate me. You know, they'll create a fake account and they'll have my picture and they'll want you to call their WhatsApp number. Trust me, I don't want anyone calling me. So if you see someone pretending to be me that wants you to reach out to them, it ain't me. But in any event, so then I turned off all comments and I started approving them manually. Well, that just is not workable. And then people think I'm censoring them. So then I get the comments, you're censoring my comment. I'm like, well, no, not really. So now I'm back to they're on. I do click this option where YouTube will, in theory, hold what may be inappropriate comments, but it's worthless, absolutely worthless. So we'll see how it goes. That's what I'm back to. So the comments are, just if I see spam comments, I delete them, but over time, it's just impossible to keep up with it. So that's that. Again, at the end of this video, I will go back and create a timestamp. So if you're watching this, particularly after the live stream is over, check out the timestamps below the video. And if I mention resources like this financial retirement calculator I'm going to show you here in a minute, I'll link to it as well. I think that's about it. Hope you had a good holiday and are safe and healthy. I'm actually getting a COVID test later today. We'll see. I don't feel 100%, but I mean, at my age, I can't think of the last time I actually felt 100%. Anyway, enough of that nonsense. All right, let me show you this calculator, and then I'll get to your questions in the chat. So I think I've shown you this before. This is called the Brain. This is one of my note-taking apps that I use. And I use a lot of them. I've tested out a lot. I like a lot of them for different reasons. This is probably the one that is the most fun to use. But in any event, the calculator I want to show you is this one. We'll flip this. Here it is. So I don't know if you can see the URL, but it's calculator.ficalc.app. So calculator.ficalc.app. And really cool calculator. So you put in how long you're going to retire for. Obviously, it's a guesstimate, and your portfolio value. And then you can click this and you can set up whatever asset allocation you want. I mean, it doesn't get into like, emerging markets and REITs and all that, but I don't think that's necessary. You can place for annual fees, which is interesting because, if you're thinking of paying someone 1% of assets under management, you could test this out, put the fees in at 1%, or, if you factor in low cost ETFs or whatever, maybe 1.05 or 1.1, and then compare that to just the cost of the ETFs or the mutual funds. Anyway, you put that in, but here's where things get interesting. And people have asked me about this, and here it is: withdrawal strategy. So this is a constant dollar. So what that means, that would be like a Bill Bengen, constant dollar on a on an inflation adjusted basis. And of course, you can click this, and it tells you, it actually mentions Bengen or Bengen. But you have other strategies. Guyton Klinger is down here. And when you click that, of course, it opens up a number of other assumptions or rules, I guess, better way to put it, that are relevant to Guyton Klinger. If you're not familiar with Guyton Klinger, those are two people. Those are their names, Guyton and Klinger, and they've done a lot of research on what a safe withdrawal rate is and different withdrawal strategies. So you can put that in there. What else do we have? A variable, I guess there's custom. I don't know what the 1 divided by n is. Let's learn about that strategy. Well, I'm not going to read all that. You can play with this. But here's the thing. Let's just go back, since we'll just use constant dollar for a moment. You can put in any additional income, any additional withdrawals. Maybe you're going to take a trip around the world, whatever, and historical data. It looks like you can even, if you don't want to use it all, you can actually select the years, because some folks complain. Complain's the wrong word, but they've written me and said, Rob, you go back to 1926 or even later, but what's that got to do with today? All right, fair enough. Well, now you can put whatever you want in here. And it gives you the chance of success, obviously. What's our withdrawal rate? So this is 4%. It's interesting to me, by the way, we're assuming a 30-year retirement, $1 million portfolio, $40,000 per year, and it doesn't have the success rate at 100%, which is what Bill Bengen found. Now, part of it you could say is the asset allocation. Oh, here's the annual fees on the, this is on cash. Okay, so there's two places to put annual fees. Anyway, you could, let's just put this to 50-50 and 0% in cash, which was one of the assumptions in Bill Bengen's analysis. Yeah, it's still, and I don't even understand this. I'll have to dig into this. Success rate's 95. Oh, nearly failed. So it didn't fail, but I think the point here is you might not fail, but you get real close to failure, and that could freak you out. At least it would me. So even though we can look back in hindsight and say, well, we succeeded, or at least most of the time, we almost didn't succeed 15% of the time, and that would have been very uncomfortable. But we still didn't succeed. What is that? 6 times, which I'm not sure. But in any event, it is what it is. Check this out, though. This is what I thought was really cool too. You have some data here, graphs, whatnot, but then it shows you by year. And the late 60s, I don't care how you run this thing, the late 60s were just a tough year to retire, tough time period. And it was mainly because of inflation. I mean, yeah, there were some bad markets, 72 and 73, or 73 and 4, I think, were pretty bad. But in any event, these were tough years. I think 66 was one of the absolute worst. And if you click that, you get data on that year. And it tells you here, your money lasted until 1989 and yada, yada, yada. Anyway, I think it's a really cool calculator, and it's free. So there you go. I could probably end the chat right now and you would have good value. I love that calculator. Anyway, thanks, Dan, for sending that in. All right. So let's get to the questions. And so Tom F. So remember, if you want me to address a topic, please tag me. I'll see it easier in the chat. And again, as a reminder, I will do timestamps under the video. Hopefully get them up later today. All right, he wants to know, I was wondering why you prefer VXUS versus VEA. I don't remember preferring one versus the other. Maybe I did. Maybe I say so many things. Kind of hard to keep track of them. But I know VXUS, that's just Vanguard's, total market excluding, that's the X. So, excluding US. That's sometimes there's logic to the tickers. Sometimes not so much. But let's pull this first one up, and we'll just pull it up in Morningstar. So it's your basic total international stock index fund. The one thing I wanted to look at before we look at VEA, and this, by the way, is a common fund used in like the 3-fund portfolio, whatnot. I wanted to look at region. Yeah, so it's a total. So it's got emerging markets. You can see that here. It's got 15% is developed and European emerging. All right, so that's the first one. We'll open up another tab and we'll go to VEA. Oh, okay. Yeah, so here's the deal. So this is developed markets. So go to the portfolio. We'll see if we come down here to region, it doesn't have any or nothing to speak of. So I would prefer VXUS, assuming that I wanted to capture all of my international exposure in one fund, which I don't always, right? So in my case, that's not how I've done it. I do have two different funds. I have a developed and I have an emerging. And the question would be, well, why would you do that versus just like a VXUS? You have everything all in one. What would be the reason? And the reason would be, well, there could be a practical reason in terms of limitations of funds in a 401k, but let's put that issue aside. Is if you want to decide for yourself how much you'll have an emerging, right? It's no different than should you have a total U.S. stock market like VTI or an S&P 500, and I did a video on that. If you look at the history, it's more or less the same outcome. But still, if I were going to have just one fund, I would still prefer total stock market. I wouldn't prefer it in the sense of if a 401k just offered an S&P, I would feel like I'm being cheated, or I mean, the differences are just so negligible. But, it's like, well, I'll take the extra diversity, particularly if it doesn't seem to hurt my returns and probably make it maybe a little less risky, but probably really not much different at all. So, but if you want to dictate exactly how much you have in large cap versus small cap, then you might prefer an S&P 500 and then a separate small cap fund, right? It's the theory. The same would be true here in Tom's question between VXUS and VEA. I think having your international exposure in just VXUS, more than reasonable. Excellent approach. If you wanted to divide it up, maybe VEA and then an emerging market fund could be an option. The big takeaway here is that there's not one right answer to this. For example, let me show you one more fund here. We could nip all of this. Okay, forget all this nonsense. We're going to go back to Morningstar, and we're going to go. They say VT and chill. They also say VU and chill, whatever. This is a total world stock ETF. This is, forget your total U.S. stock market, forget your S&P 500, forget your emerging market, forget your developed countries. Just go with this. And if we look at the portfolio, we can see it's 59. We'll call it 60% U.S., 40% non-U.S. And if we go down to regions, we'll see some developed, emerging. Yeah, here's emerging. Asia emerging. There's also European emerging, but 6%. So could you just have VT? You could. And then why do we get a little more complicated? If we want to make some allocations between, say, U.S. and international that are something other than 60-40, which is VT. And then you break international and U.S. apart. And then the question is, well, how much emerging do you want? Well, is VXUS good, or do you want more or less emerging? And so you can just you have to decide for yourself what level of control you want. The more control you want, generally the more funds you have to have. It makes managing it a little more cumbersome. I think years ago, I wanted more and more control. I had it all figured out down to the last allocation percentage. And as I've gotten older, I care less. I still have a 6-fund portfolio. That's kind of just worked for me. I don't know. I hope that answers your question, Tom. So yeah, but the end of it, VXUS and VEA are both great funds. Just it's like saying, do you prefer this ingredient for food or that? Well, they're both good. Depends how you use them, how much you put in. Iana asks, can I buy shares of the capital management firm, had IPO this year, that purchased? Oh, is it insider trading? Oh, I can't answer that. Do you still work there? I mean, I can tell you this. I worked at a publicly traded company, and there were windows when you could buy and sell. Now, I was in the legal department, obviously. Well, I shouldn't say obviously. I was a lawyer. So I was in the legal department. So I had extra obligations that if you're not, in a position where you might have knowledge that your typical employee wouldn't have. I had additional, sort of obligations, but they usually had, like, if you have an employee stock purchase plan, there are usually windows as to when you can sell, but I can't, there's no way I could begin to answer. There's no way I could even begin to give you meaningful input on that other than speak to a lawyer. They might have someone in your company you can speak to that's designated to help employees with this. But it's a good thing to get right. You don't want to get it wrong. Akeem, thank you. Appreciate it. Right back at you. Displaced Hoosier. Good morning, Rob from South Florida. Happy New Year to you and your family. You as well. All right. What else we got? Greetings from Oklahoma, Howard. Welcome to the show. You guys have been very cordial today. I like it. Normally it's just, let's get right to the questions. Mike says, the crazy man in the pink wig is here to learn more. You do great work, Rob. Thank you. Can't see the wig, but I can try to imagine it. Alex, how's come Christine Benz, and she's at Morningstar, has a BA in Eastern European Studies and then became a leading financial analyst in Morningstar? What did she do right? I don't know. But I was an English major. Of course, you'd say to that, yeah, and that's why you're not at Morningstar. You're at home behind a camera. But honestly, I'd rather be here than at Morningstar. I'm just curious. Let's look her up on LinkedIn. Is she on LinkedIn? My kids make fun of me because I have like 4 Facebook friends, but I've got thousands of LinkedIn connections. By the way, I only know like 4 of them, but whatever. I don't need to tell people that. Here she is. She's been there for a long time. Yeah, political science. Whoops, I didn't mean to click that link. Political science, Russian and Eastern European studies. I don't know. It's a good question. Let's see if they say anything in her bio. She was on the show, or was it? Yeah, she was on this show, right? I do a podcast as well, talking about because she's a big believer in the bucket strategy, and I wanted to get her take on it, and it's just not my thing. Yeah, I don't have an answer to that question. I don't know how she did it. If I ever interview her again, I'll ask her. Mike wants to know, and remember, if you're keeping records at home, he's got the pink wig. Have you considered adding VFSAX? There is further diversification there beyond VTIAX based on capitalization and country allocations. I can honestly say I've never considered it. At least I don't think so, but I first have to see what VFSAX is. All world. Oh, it's small cap. And I'm going to I'll show you all this in a sec. Let me just pull it up. What's the other one? VTIAX is just a total international. So this is just a total international. So this is kind of the same question in a way. So this is the Vanguard. This is Financial Times Stock Exchange, but if you want to impress your friends at a party, you pronounce it FTSE. All wild, just kidding, all world, X, so excluding US, small cap, index, and it's Admiral shares. That's what all that means. Admiral shares is just a class of share that Vanguard, they have an investor class and Admiral. Used to be a big difference. Now I think they've merged most of them. Anyway, if we go to the portfolio, we're going to see it's actually, according to Morningstar, is on average a mid cap, but close to the small cap line blend. Look at the price earnings, by the way. I mean, that's a combination of small cap and international. You compare that to the S&P 500, it's probably, and this is forward looking, I'm pretty sure. But if we go back to the VTIAX and we look at the portfolio, my guess is this should have, I think, some small cap, but very little. And the way you figure that out, or one way, is you see this box here. The blue dot is sort of the weighted average of the fund, and this top row would be large companies as defined by Morningstar, and then the middle row of this tic-tac-toe board would be mid-sized companies and the small companies. But if you click this weight here, it should give us numbers in each box. Boom, there it is. And so you can see it's 5% in small cap. So think of it as every dollar you invest in this fund, 5 cents goes to small cap companies and 18 cents, right? 6, 12, yeah, 18 cents goes to mid. And if we come back over to this FTSE small cap, and we go to weights, it's obviously heavily weighted. So again, this is very similar in concept to the question Tom asked at the top of the show. You have to decide, are you comfortable just with one fund, or even we go back to VT even. Let me put that in because VT is going to have some small cap, right? It's a question of degree, right? And how much complexity you want in your portfolio. And it's not really that complex, I guess, right? But still, you could have all your stock in one fund. So we go back to international, and I talked before about like VXUS or VTIAX, plus maybe an emerging market, although this one, let me just make sure, this probably already has emerging. Yeah, so it does. So, do you want to have this plus small cap? It would overweight your portfolio to smaller companies. And what I mean by overweight is this is going to basically track the market, more or less. Remember, this is a public market. Most companies are private, but in any event, this is going to track the public market. And so what you're saying, if you say, well, I want to put 10%, let's say, in this fund, is I want to overweight small and mid-sized companies as compared to the market as a whole. And it's a perfectly reasonable approach in my view. I do the same thing with emerging market. I overweight emerging markets, right? I mean, not by a lot. Well, it's 10% of my portfolio. A lot of people do that in the U.S. stocks. You overweight small cap. I do that as well. I have 10% in U.S. small cap. Could you do the same thing here? You could. How the thing you just have to, I think the more important thing is pick something you're comfortable with. I would keep it reasonable. And, what's reasonable? I wouldn't put 40% in the small cap fund. That's me. But, 10% maybe, or some relatively smaller percentage of your international exposure. The real key is to come up with a plan and then just stick to it. Because here's the thing. No matter what you do, you're going to underperform some other reasonable approach always. It's almost never going to be the case that what you pick will outperform all of the other different ways you can tilt your portfolio. So you just got to be able to live with it. And it can be hard. If you're a big value investor like I am, I've lived through 10 years of growth. Now, I haven't missed out because I have a total stock market or an S&P 500, and it covers that. But I do tilt towards value. And so my portfolio has underperformed. Although, in fairness, in my case, a lot of my tilt towards value is in individual stocks, and they've actually done very well. So maybe I haven't. But I would be the first to say I got lucky. So hope that answers your question. All right. So Tyler says, if you considered having Karsten, I guess it's Jeske, but it's Big Ern, and I'll show you his website. It's a good one for retirees or folks planning. And he wrote a book too, Early Retirement Now. Here it is. And one of the things, and he does great work. I think he was maybe an engineer. Let's see. He thinks like one, and he's tall, apparently. Okay, he's got a master's and a PhD in economics. In any event, he's the one that's done, I want to make sure I get this right. Yeah. He's done a lot of work on the 4% rule and safe withdrawal rates. He has a whole series. It goes on and on and on. So you could spend all day on his site and find great content. In any event, So highly recommend that. I have not, but it's not a bad idea. And I know he does interviews. I'll look into that. Clarissa. Hello, Rob. I have $40,000 in a 401k rollover from a divorce, and I want to know your opinion. Should I roll it over to my current job's 401k? They only match 3%, or put it in my Vanguard IRA? It was a good question. I actually did a video on it. My last video was on 401k rollovers. I'll drop a link. But there's something specific to your question, though, that I want to cover. But let me pull up that video. I thought I did. Here it is. It's probably going to start playing and making noise. All right. I'm going to drop this in the chat. At the bottom, I guess. I don't know how this works. What do I know? But Clarissa, one thing in your question. So you mentioned your employer matches. So just understand, though, they won't match the rollover. At least I can't fathom that they do. I don't even know if it's permitted. They'll match your contributions. And so my view has always been, by the way, I suppose you could confirm that with them, but I would be stunned if they match a rollover. I can't imagine they do. But yeah, I guess you could check. So I always want to take full advantage of matching, though. So if it's just contributions, that's fine. You can contribute. Beyond that, I'm going to assume it's a traditional 401k, although you didn't say. But I'm going to assume that. The first question would be in terms of the rollover decision, do you like the investment options that you have at your current employer? Low cost, for me, it'd be low cost index funds. If you like the options, then one advantage to putting it in the 401k is just keeps life simpler. You don't have to have a separate account unless you already have an IRA. Although, again, when you do a rollover to an IRA, you want to put it in a rollover IRA, not a traditional IRA. They work the same way in terms of taxes, but you get some extra protection from creditors with a rollover IRA as compared to a traditional IRA. And in many cases, you can take a rollover IRA and roll it into a future 401k. So you get a few more options. You can take loans from a 401k. You can't from an IRA. It's not something I do or have ever done. There's the Rule 55. I went through all of this, or a lot of this, in the 401k rollover video. When you get to 55, if you retire from your job at 55 or older, you can start taking money out of the 401k at that job without penalty. So in other words, you don't have to wait until you're 59 and a half. But it only applies to the 401k you have at the job that you retire from at age 55 or older. Doesn't apply to previous employers where you may have left a 401k. Doesn't apply to IRAs. So you want to, I don't know how old you are. Those are things to think about. And check out the video. I'm actually going to do some more. I've been working on a video. I'll show you this. See, this is what you get from the live Q&A. I'm back to my note-taking app. So I've been thinking about 401k rollovers and where to roll them over to. And I've done, where to open an IRA account kind of videos in the past. But this one's a little different in that not everyone, but a lot of people that are doing 401k rollovers are nearing or retiring or near retirement. Of course, not everyone. You may change jobs when you're 30 or whatever, you do a rollover. But when you get near retirement, your needs change. You have cash management needs because you're going to be pulling money out. There are certain tools you may want. You're going to, of course, want them to calculate your RMDs and withhold your taxes potentially. And again, that may be down the road. But so I've been looking at brokers from that perspective. And I'll just give you a quick, my quick take. I think Fidelity, probably one of the best broker, but really, really good in terms of what they offer, their fees, their customer service. Schwab, I like a lot. And if you want a robo, of course, Vanguard's is good. But I like also, I'm a big fan of Betterment. I know I'm going through this quickly. I'm going to do a separate video. And Wealthfront. And a lot of these, they offer great cash management. The Vanguard doesn't actually. That's one of its weak points. It had a debit card. It got rid of it. I'm not quite sure what happened there. But at Fidelity, if you want, you don't even have to have a bank account. You can just have it all at Fidelity, or all at Schwab, or all at Betterment, or all at Wealthfront. You have a checking account, online bill pay, debit card. You don't have to do it that way. You can just have your traditional bank and transfer it over. It's not hard. But I'm sort of walking through all those things. Anyway, Clarissa, I know that's not what you asked. I hope my response was somewhat helpful. Jared, I am struggling whether I should have a trust and will set up. Just spoke to our trust and estates attorney yesterday. I know the idea is to avoid probate. You said probation. I definitely think you want to avoid probation if you can, but you also do want to avoid probate. Someone told me I just need to have all beneficials listed in all financial institutions. Okay, it's a great question. So I am a retired lawyer. I am not a trust and estates lawyer, nor have I ever been. I paid someone to do our wills. I don't know wills. I don't know trusts. I mean, I know what they are. You need to go to a specialist. So this is not legal advice. All I'm giving you is my take on all of this. So there are some assets that you can that can go from you that you own to someone else without going through your will and probate, right? Think of payable on death. So it could be a bank account that's payable on death to someone, or a real important one is an IRA, where you could list, you could not list a beneficiary, and it would then go through your estate, but that would be a mistake. And it's very easy to list your beneficiary. All of the different platforms, they'll even remind you, hey, you need to add a beneficiary. If you're married, and again, there could be exceptions to all of this, but and assuming you're going to leave it to your spouse, you want to list your spouse as the beneficiary, even if he or she is the beneficiary in your will, because it will go directly to him or her without going through probate. And an inherited IRA, a spouse who inherits an IRA, can treat all of that as his or her own. It's like they can just fold it into their existing IRAs. If you inherit an IRA from someone other than your spouse, you're forced to take the money out over a period of time. Now, it changed recently. I think now the time period is 10 years. It used to be you either had to take it all out over a 5-year period, or you could choose to take it out over your lifetime. And they calculated an RMD, not unlike how they calculate RMDs when you hit 72. But in any event, you can add beneficiaries. It's like a house. Tenants by the entirety with a spouse. If I die, my wife just owns the house. There's no going to court. So you can do that, Jerry, but it depends on your situation. Let's say you own a home and you're single and you live by yourself. That's probably to my knowledge, well, you could have a trust, but see, then you need a trust. You could put it in trust and avoid probate. So I feel like I'm rambling. One of the purposes of a trust is to avoid probate. And you could talk to a trust and estates lawyer to understand that and how you would set that up. So on some accounts, like I said, you just add them as a beneficiary, and that does it. It'll go to that person when you die. By the way, just to add complications to it, you can list as a beneficiary a trust, right? So one approach would be to list your spouse as the beneficiary of, say, an IRA or 401k, and then a trust as a secondary beneficiary in the event that your spouse is not alive when you die. You both die at the same time, and that gets complicated. But whether you need a will and a trust, it just is very specific, and I think you need to talk to a lawyer. It's probably not what you want to hear because it's pain, but you have to do it, I think. If I were single and didn't own any real estate and had a couple of financial accounts and that was it, but like even your personal belongings, I mean, maybe your family would just deal with them. I think it's better to have end-of-life documents power of attorneys, you know, how you want, medical care, um, a will and a trust, and we just got them all at the same time. Andrew, what do you think of FNCMX as a total market fund in a 3, 4, 5, 6 fund style portfolio? Well, let's take a look. So if you're new to Morningstar, by the way, you see I come up to this quote box. I'm not signed in. This is all free. I no longer have a paid subscription to Morningstar. It can be worth it depending on your needs, what you need, but I don't think I like this fund or whatever. This has got me concerned right here. Let's take a look at the portfolio. So it's, an S&P 500 is going to be a blend. This is obviously growth, and that's the NASDAQ kind of gives it away. High PE, that's because it's growth. It's got 3,000 equity holdings. So this must have got to have small cap and mid cap, right? Yeah. My concern with this as sort of the core US holding is that it's not all, but it's heavily tilted towards growth. That's my concern. I personally wouldn't choose this. I suppose if you wanted to tilt your portfolio to growth, this might be one way to do it. But you'd have a total stock market or S&P 500 fund as well. The problem, I think there's two problems with using this as sort of your US stock exposure. The first is it could significantly underperform the S&P 500 over a given period of time. I know it may not seem like it because it's probably clobbered the S&P 500 the last decade. In fact, let's take a look. We might as well get Portfolio Visualizer all fired up. That's not what I want. So I'm on Portfolio Visualizer, going to enter a portfolio. This was what? FNCMX. I don't know how much data Portfolio Visualizer has on that fund, but we'll find out. I'm going to guess FNCMX beat the S&P 500 over the last decade. So it's got a decent amount of data from 2004. It's clobbered it. Of course, we're looking at a very specific time period. So you can see they were basically neck and neck until 2013. And then it's, as growth sort of accelerated, it obviously outperformed. We can look at it year by year. The problem, so there's two problems. The one is that while it's done really well recently, there's no guarantee. And in fact, I would probably bet against it doing as well over the next 10 years. I could be wrong, of course. But there are times when value outperforms for long periods of time. And so over your investing time horizon, whatever that is, you're taking a risk that it could significantly underperform the market. And so again, it's one thing to tilt your portfolio to growth. Maybe you have a core S&P 500 or total stock market, and then you put 10% in QQQ or some other growth fund like this one. That's one thing. But to use it all as sort of, and this may not be what you're asking, but that's how I interpreted your question, as sort of your core US stock fund, that's taken it pretty extreme in my view. But the other thing is, I think for me, it would be hard to stick to that plan if there were, 5, 6, 7, 8 years underperformance. Like, how long can you take the punishment and stick to that plan? Yeah. So those would be my concerns, Andrew. So My Millennial Mortgage Journey, that's their name. It's a lot. The birth certificate must be something. Anyway, am I allowed to contribute to a Roth 457B and a Roth IRA in the same year? Well, normally my question would be, or my answer would be absolutely. The problem is the 457B. So first of all, can you contribute to a workplace retirement account like a 401k or a 403B or the TSP on the one hand and an IRA on the other, in the same year? Absolutely. Absolutely you can. My only hesitation is I'm not really familiar with the 457B. I know that it's a retirement plan. I think for state workers. No, let's see. Let's figure this out together. Yeah, so it's local governments. You got to be able to. You've got to be able to. According to the Nest, the answer is yes. Which makes sense to me. Because they normally treat workplace retirement accounts on the one hand and IRAs on the other as separate. It can get a little wonky. There's some funky rules like around SEP IRAs and stuff. But in any event, I'm pretty sure the answer is yes, but you could just talk to your plan administrator to make sure. Or, you could even talk to wherever you open your IRA, Fidelity, Vanguard. They'll be able to answer, give you some comfort. Neil says, did you see the news about how Vanguard's website has been down for over a week? I did not, and I've been on their website, and it works for me. I do have a comment, though, about Vanguard in a minute related to this, but let's just Google Vanguard's website is down and go to news. Here's a Philadelphia Inquirer. Yeah. Vanguard's partial website outage hits customers looking for year-end statements. So this is part of the where to roll over 401k video I'm working on and evaluating the brokers. And you guys know I'm a Vanguard diehard, love Vanguard. I called up the other day and they have a voice recognition system now. So they put me through that and I do that thing. And then the rep eventually gets on the phone and they start asking me all of the identification questions. And so I answer them all. And then I said, I thought the voice system was supposed to do that. Like, I'm just curious, why do I do the voice system? And then, you ask me all the security questions. I mean, I love security, so I'm happy to do both. But I was just curious. Oh yeah, the voice thing hasn't worked. It's not working right. I'm like, that's odd because you put me through it, not you, the rep, but Vanguard. And I said, well, how long's that been? Oh, a month or two. I'm thinking, really? And then they had another issue, but I forget what it was. One of the things I was looking at is technology when I evaluate these brokers. And one interesting data point, another reason why Fidelity is high on my list, they invest $2.5 billion with a B, $1 billion a year in technology. It's amazing. Now, for all I know, so does Vanguard. But I've had some concerns with their platform, not from I'm going to lose my money, but yeah, it's a little troublesome. I didn't know about the partial outage though. So great question from Akeem. He wants to know, what do you think about a 90-10 portfolio? The 90% would be in VTI, Total U.S. Stock Index Fund. And then for the 10%, either BND, which is a total bond fund from Vanguard, or VTIP, which is another Vanguard fund. It's TIPS fund. Now, before I answer that, and we've talked about this, my opinion is, yeah. So it's a great question. And this is where you got to really make sure you understand the comparison. So BND, we'll look at both of these. I'll pull it up on the screen here in a second. I'm going to start with BND. So when we look at BND and we go to portfolio, what we'll see is government bonds, right? 50% roughly. Corporates and securitized, I'm thinking mortgage-backed securities and whatnot. That's the fund, right? And now we come over here to VTIP, and it's effectively 100% government bonds. I guess there's some cash, but as we know from the name, and yeah, it's investing in TIPS, Treasury insurance protected securities. So again, and I got to use my hands on this one. So the way a TIP works is it has a fixed interest rate, but the principal. So if you bought a $100 TIP, of course, here we're buying it through a fund. But when the fund buys a $100 TIP, that $100 principal amount, normally the way a bond works is they pay your interest, whatever the rate is, for the term of the bond. Let's say it's 10 years. And then at the end of the 10 years, they make their final interest payment, you get your $100 back. But with a TIP, you don't get $100 back, at least as a practical matter. That $100 is going to go up when we have inflation or down if we have deflation. So the interest rate stays the same, but it gets applied to the principal balance, whatever that is, as it goes up or down based on inflation. Of course, now we're kind of concerned about inflation. So, for a 10-year bond, you end up getting a lot more than $100 back, right? So that's how it works. Now, you say that's great. Why don't all bonds work that way? Well, it is great, but you pay for it. There's a fee they charge you for that benefit. What's the fee? A lower interest rate. If you say, well, I don't want that benefit, then you buy a 10-year treasury and the interest rate's up here. And that delta is they call it a break even. And we can even look up with that delta on Fred, a Fed database. Anyway, but here's the thing. I want you to look at this. Go back. I want you to look at this. Who can tell me a really important difference between these two funds? This is the TIP. Take a look at the data. A lot of data. It's like a chess game. A lot of pieces on the board. The key is to figure out which pieces and squares really matter. And now we go over to the BND. There's one really big difference beyond the fact that BND doesn't have TIPS and VTIP only has TIPS. That's obviously pretty important, but there's another big difference. Effective duration. BND is, we'll call it 7 years. This is 2.5, which means if interest rates go up, BND loses roughly, for every 1% interest rates go up, BND loses about 7%. The TIPS loses, in theory, about 2.5. Of course, TIPS work differently, so it's not quite the same thing because you're going to get principal balance goes up. So in fact, it isn't the same thing. But duration affects interest rates and yields, and so So the point back to Akeem's question is there's two key differences: TIPS versus no TIPS, and a 2.5-year duration versus a 7-year duration. My approach would be, I think the best approach for me would be to put half of my bond portfolio in something like BND, and the other half in a TIPS fund. Could be short term like this one, or maybe an intermediate term. So 50-50. I think that's sort of my sweet spot where I am. Could you pick one or the other and probably be okay? Yeah, probably. If I were only going to pick one, though, I'd probably pick BND, which may seem odd because we're all concerned about inflation, and maybe it is odd. I just like the added diversity of the corporates and mortgage-backed bonds. Some don't, though. Some actually say that's a reason to avoid BND, or why they don't prefer it. Anyway, hope that helps. I don't know how that could possibly help you, Akeem, what I just went through, but maybe it does. Okay. Remember, I'm sick. I'm not feeling 100%. Jared, are there any benefits to keeping a 401k at an old employer over rolling it up, over a rollover IRA? Is there a Roth rollover IRA? Those are great questions. Of course, I put the link into the video, which might answer some of those. To my knowledge, I do not believe there is such a thing as a Roth rollover IRA. That's based on asking folks like Vanguard and Fidelity and Schwab, hey, do you have a Roth rollover IRA? Nope, they don't. So there's a rollover IRA and a regular IRA, and then there's just a Roth IRA, as far as I can tell. And by the way, if anyone knows any different, and I'd love to hear it, but I've actually looked for that. I don't think there's such a thing as a Roth rollover IRA. And in terms of the pros and cons, well, I mean, if you like your investment options at the old 401k and you've got enough that you're allowed to keep it there, which in my experience has been at least $5,000. I don't know if that's set by the plan, by the IRS, but whatever. The nice thing is you don't have to do anything. You just, you're done. You just leave it there. And I've left a 401k in place for over 20 years. Almost 20, I guess 19. So I'm actually rolling it over now. So that would be it. If you don't like your investment options, you want to roll it over, you can roll it into a rollover IRA, assuming it's traditional. If it's a Roth, then I don't know about rolling a Roth 401k into a Roth IRA and then later into a future employer's Roth 401k. Don't know about that. So if you thought maybe if it's a Roth and you thought maybe in the future you'd like to roll it over to a future employer, that would be maybe a reason to keep it in your current 401k, subject to figuring out this whole Roth rollover IRA mystery, which I have not been able to solve. Or maybe I have solved it, and the answer is no, they don't exist. All right. Vishnu, what do you think about holding 15% in bonds in your 20s when you have a stable job? I think an 85-15 portfolio in your 20s is perfectly reasonable. I had 90-10. That's what I would, if I were picking something, that's what I would pick. But in the range of reasonableness, I think an 85-15 portfolio fits just fine. By the way, I know that the current thinking is bonds, they're expensive, yields are low, but I'm going to tell you, we start to see yields go up, people are going to get really excited about bonds in a hurry. Of course, I don't know what that means. Just sends the yields back down? I don't know. I guess we'll find out. It's funny, I've had a lot of questions. This is from a displaced Hoosier again. There's always Ohio. I'm just saying. Although they didn't do very well in their last game. Oh well. Thoughts on iShares Core US Aggregate Bond ETFs? It's funny, they've come up recently. Maybe I need to do a video on them. They seem pretty good to me. They're like Vanguard Life Strategy funds. You mentioned AGG, so let's just take a look at it together. Here it is. If we go to portfolio, so remember life strategy funds, there's different allocations, like 100% stocks, 80-20, 60-40, whatever. This one is percent. This is the most conservative, right? It's fixed income and cash. And so it's all investment grade, meaning BBB or higher, a mix. So it's not exactly, but not unlike BND. And there's some of its bond holdings. You've had something else in here. Inherited some of this fund and decided to keep or reallocate. Well, that's a different question. I think it's a bond fund. So I inherited a small amount of money, and it's in an inherited IRA, and I just work it into my overall asset allocation. Now, there's two different ways. There's really a couple different ways to think about that. If it's a relatively small amount, and what I mean by small is relative to your portfolio as a whole, I try to come up with a way to involve it in my asset allocation that won't require any future work. So it might be, I'm just going to put it in a target date fund and then ignore it, or a life strategy fund and then ignore it, or I know I need 10% in emerging markets, and I'll just put all of that inherited IRA in an emerging market fund as an example. Now, you could get into some interesting situations where you've got this portfolio and you're going to have to start drawing from it. And then you might think, well, some of this I'm going to need soon, but much of it I won't need for years, decades even. And so should I figure out which accounts I'm going to draw from and then allocate accordingly? So like this account will be my account that I need over the next 5 years, and I'll make it more conservative. I suppose you could do it that way. I generally don't think of it that way, particularly if a lot of your money is in retirement accounts where you can rebalance without triggering taxes, because you take out money and just rebalance. You end up back to whatever asset allocation you have. And I don't quite know why I'm doing this with my hands. I worked with a guy named Ray. He's probably not watching at the PCAOB. Enjoyed working with Ray. He was a big hand guy. It's always this. So there you go. David, can you roll an IRA? See, by the way, I can already tell these questions are great. These are end of year questions. That's what you guys are doing. I know what you're doing. It's like end of year. It's like changing the batteries in your smoke detector. Let's kind of get all this stuff we've been, pushing off. Let's get it done. All right. Can you roll an IRA from one place to another without liquidating? Well, not necessarily. It depends. Well, I don't know if it depends. I've actually come up with, so first of all, it's an IRA, right? So there's no tax consequence. You could sell to cash, no taxes. Transfer it to another IRA, it doesn't trigger any taxes, and then reallocate it. So I'm not sure why you, in a taxable account, you obviously want to transfer it in kind, they call it. Don't sell it, just move the assets, from one broker to another. With an IRA, I'm trying to think, because I was just talking to a broker yesterday about this. And there was one account that had to go to cash if I wanted to transfer it. And it may have been a retirement account. I can't remember now. But I don't know if that's applies to all brokers or it was just this broker. So the way to find out for sure, David, is to call the place you want to transfer it to. But again, there's no tax issue. So my question to you would be why, some people get a little nervous because you're out of the market for a few days or whatever. I don't know. I get that, but it's never, I don't know. I don't lose any sleep over that. Scott says, do you take geopolitics into account as part of your overall investment strategy? I really don't. Not at all. It's funny because when there are problems, like take China, for example, which is, had an interesting year and it's caused a lot of issues in their markets. But a lot of times, the conventional wisdom would be, well, we got to get out of China now, our investments, because, who knows what they're going to crack down on next. But over the long periods of time, those periods of disruption can often be the best times to be investing long term. And I've just concluded that I'm not good at making those sorts of predictions and knowing. I'm just much better off leaving it alone. It's funny when I talk to brokers, because I've been talking to a lot of them, for this 401k rollover. By the way, here's a tip. If you're trying to figure out a broker, you're looking at Vanguard, Schwab, Fidelity, whatever, Betterment, whatever. You can create an account. Now, you've obviously got to get for your personal information, Social Security and all the numbers and all that, but you can create an account without actually moving money onto the platform. And by creating an account, you get access to things that you can see and check out that you couldn't without creating an account. And it might help you make a decision. It's just an idea. So, but anyway, back to that, I just don't take, what was I saying? Oh yeah, but in talking to these people, I need more coffee, and this is actually caffeine-free tea. Our financial system, when it comes to investing and the platforms, it's built on active trading. Obviously, the Robinhoods of the world, that's all they want is you to trade. The last thing they want is for you to be a buy and hold, low-cost index fund investor. They would go bankrupt. It's not in their owners' best interests for you not to actively trade. They want you in options. They want you investing on margin. They want you in crypto. They want you in gold. In and out, in and out. That's what they want because it makes the owners wealthy. And the platforms are built for that. The pro trader platforms, all the software that's got all the graphs and all the technical analysis you want, unlikely to make you wealthier than just low-cost index fund and then ignore it. I was talking to one broker that said, are you unless you day trade? And I said, no, I don't day trade. I'm more of like a decade trader. Okay. Hannah. By the way, great show. I just finished the 3rd season. He's tough. What are your thoughts on covered calls? You may answer. Oh, you may have answered it before, but I missed it. Well, I haven't answered it today. There's part of me that wants to dive deep into options trading because the math person in me would find it fun. The problem I have with, so you think about a covered call or any option trade. There's two reasons that you might want to buy or sell an option. Now, there's probably more, but I think that more or less they can be boiled down to two. One is you want to make money. Seems kind of obvious, I guess. Maybe it is. But the other one is you want an insurance policy. You're concerned that you're in a long position and you're concerned the stock could drop, and so you buy some puts, which gives you the option to force the seller to buy your shares at a strike price. Let's say that's whatever you buy it at, 10% below the current market price or whatever, and you're buying it for insurance. That can make some sense. For individual investors, I don't think so. But there's some complex trading strategies that are well above my head that can make some sense. But most people that ask me about like a covered call, they want to make money. So a covered call, let's say you have 100 shares of Apple. Let's just say it's trading at, I don't know what it's trading at, $1.70. Am I way off? No, $1.80. So it's trading at 180 bucks. I could sell a covered call. One covered call would give the buyer the right, but not the obligation. They can, but they don't have to buy my shares from me. And by shares, it would be each covered call, each contract covers 100 shares. So they could buy 100 shares of my Apple stock at some price we agreed to. They call it the strike price. Most people think, well, if you're going to give someone the right to buy your shares trading at 180, whatever the strike price is, it's got to be more than 180, right? Or it wouldn't make any sense. Well, no, I could sell it and have a strike price of 170. It's $10 below its current price. I just would charge you more than $10 per share for that option, right? But in any event, most of them are out of the money, meaning the strike price is above the current market price. And so the thought is, I'm going to get a premium, right? It's like an insurance policy. I'm going to get a premium, and I keep it no matter what, even if they don't exercise the option. And so the idea is, if it's traded at 180, maybe I'll sell a, it's going to expire in 4 weeks, or it could be longer, could be shorter, and maybe make it 10% above the current market price. And so the theory is, I get to keep the premium. And my worst case is the stock just takes off because whatever, the iPhone 47 gets launched or something, and they make $1 trillion. But it's a short-term covered call, let's say. And my worst case is the premium plus 10%, because I'm going to sell, the strike price is 10% more than current price. So in a month, I'll make 10% plus the premium. How bad can that be? Well, it's pretty crappy if the price goes up 25%. You've just taken a bath. You've lost a lot of money. It just doesn't feel like you've lost a lot of money because you cashed in. It wasn't like you had to pay out, but you've really made a really bad deal for yourself. And so in order for covered calls to make sense for me, particularly short term, I have to have some belief as to what the price of the security is going to do in the short term. And there are some people who really believe they can do that. Kathy Wood, not specific to covered calls, but she makes predictions all the time. She's predicted oil will be at 12 bucks a barrel. She made a long-term prediction on Tesla. She's made a prediction on her own funds, up 40% over the next 5 years. She's making prediction after prediction. And maybe she's good at it. She predicted one for Tesla and nailed it. I'm not so good at it. So because of that, I'm not a big fan of covered calls as a way to make money. And I think most people that regularly sell covered calls don't really keep good track of their performance, because you can have winners, meaning they don't get called away because the strike price doesn't get hit, and you get to keep the premium. You could have one after another, winner, chicken dinner, and then you just have one bad one. It doesn't feel bad because you made 10%, but the stock went crazy that month or that quarter, and it could wipe out all your gains from all of the previous covered calls you sold over whatever the last 6 months or a year. So I'm not, Hannah, I know this is sort of a long-winded, another rambling answer. I'm not a fan of covered calls. There's a lot of people that are, and you'll find tons of YouTube channels where they, and some of them are quite good. I've watched some of them. They're very good at explaining how they work and the tools and the technical analysis, but profit, I don't know. So LT asks a question that is similar to one asked earlier, I think by Akeem. What do I think about a 90% VTI portfolio, so total stock market, and 10% in cash? And I guess the cash covers 3 years of expenses. Well, here's my question for you. I'm gonna answer your question with a question. So your 10% covers 3 years of expenses. All right. A year from now, you've spent presumably a third of that cash. What do you do? Do you take whatever that amount is out of VTI and refill the 10%? Which is kind of another way of saying rebalancing, I suppose, but it's different, right? Because you could spend a third of your money out of the cash account, depending on what the markets did. You could still be at a 90-10 potentially, but not have 3 years worth of cash. So the first question is, do you want 10% in cash or do you want 3 years of expenses in cash? Here I go with my hands again. I'm not a fan of the 3 years because effectively all you're doing is pulling money out of the stock market every year. That's the whole bucket strategy. I'm just not a fan of it. A 90-10 portfolio, I think, again, depends on the circumstances, can be a good portfolio. If you're in retirement, though, and maybe you're not, maybe I'm just assuming that. To me, 90-10 would be too risky in retirement. I generally wouldn't want to go above about 75% in equities. That's my view. It's largely based on Bill Bingen, but it's just also based, there's other factors. Look, two people could have a 75-25 portfolio in retirement and be worlds apart. Because for one person, that 25% could in bonds or bonds in cash could represent, let's say, 6 years worth of expenses. But for another person, it could represent 20 years because they have both a lot more money relative to smaller expenses. So I do think it's worth looking at your fixed income and asking the question, how long could I live on it? It's not a bucket strategy. I'm not basing my asset allocation based on buckets that are defined by years worth of expenses. But I do think how many years you could live on your fixed income is relevant when you're near and entering retirement in assessing what your asset allocation as a percentage should be. So yeah, I hope that makes sense. But so the other question I have is, why not some in bonds? I understand the issues with bonds now. Of course, cash, you're basically earning nothing. I guess you could put it in, a high yield bank account. Axos Bank is probably about the highest. It was 61 basis points. I'm just looking it up here, see if it's still 61 bips. Here it is, by the way. Yeah, 61 bips. There might be some local banks or something you could do a little better. But it's not great. But it is what it is. Okay. Hog Heaven. Love the name. Retiring early 2022 with a portfolio including a 401k. Will not need to tap this account for at least 5 years. And then in parentheses, 5-year rule, ? Interesting. I'm actually doing a video, working on it now, on the 5-year rule. There's 2 of them. Is it worth considering rolling over into a Roth IRA? Okay. So I'm going to first assume that your 401k is a Roth. All right. Now, if you have employer match, the match would be in a traditional 401k. So you could have both. But here's the deal. There are 2, let's start with Roth IRAs. There are 2 5-year rules. I wish one was like 4.5 years to make them different. Whatever, there's 2. The one relevant to Roth 401ks is the following rule. And it says, in order to take a qualified distribution, that's IRS speak. From a Roth IRA, one of the requirements you must meet is that you must have held the Roth IRA for at least 5 consecutive years. Now, a couple things about that. Once you've satisfied that rule, you've satisfied it for all time. And it doesn't matter how many Roth IRAs you have. It doesn't matter if you open up more in the future. If you open one up in your 20s and you held it for 5 years, 5 taxable years, you've satisfied the rule. And you're done with that one. There's another one relating to conversions. I'll save that for the video. Now, by the way, if the 5-year rule, what does it do? Like, what happens if you violate it? Well, remember, you can always take out contributions from a Roth IRA. And by the way, hog heaven, I know you're talking about a 401k. I'll come to that, but we have to establish some sort of foundational things. So if you can always take out contributions from a Roth IRA, penalty and tax-free, always, at any time. Earnings are another matter. And so the deal is, for earnings to come out penalty and tax-free, it's got to be qualified distribution. And again, one of the rules is you have to own the Roth IRA for 5 taxable years. And then, of course, there's the whole 59.5, unless some other exceptions apply, like you died. Let's assume you're not dead. I'm being a little goofy. There's also disability. I mean, there's important exceptions, but we're just going to stick with the 59.5. Here's the thing that people, with this 5-year rule, the one that applies to the Roth IRA account, not the conversions into a Roth IRA, is that even if you're 59.5 or older, you still must satisfy the 5-year rule. If you don't, let's say you're 60 and you take money out before you've satisfied the 5-year rule, any earnings you take, remember the contributions you can take out penalty and tax-free. Any earnings on those contributions that you take out are subject to tax. Now, the 5-year rule has nothing to do with the 10% penalty. That gets judged by other factors. So if you were 58 and you took it out and you violated the 5-year rule, you're going to get taxed and a penalty. But if you're over 59.5, you won't pay a penalty, but you could get taxed on the earnings if you don't satisfy the 5-year rule. All right. And I should also say, you need to verify all this because I'm just a guy with a YouTube channel. Roth 401k also has to satisfy the 5-year rule. But here's the thing. If you roll over a Roth 401k into a Roth IRA, whether or not you've satisfied the 5-year rule with a Roth 401k becomes irrelevant. It's not in there anymore. It's in a Roth IRA. And you say, well, I can carry over the time served, so to speak, right? From the Roth 401k to the Roth IRA. No, you can't. It's irrelevant. It's like it never happened. You move it over into a Roth IRA. Have you satisfied the 5-year rule, or will you before you take earnings out? So you need to sort of factor all that in. I mean, if you've had a Roth IRA for 5 taxable years or longer, then you're good to go. And in fact, it can help you, right? Because let's say you've only had a Roth 401k for 2 years, but you roll it over to a Roth IRA that you've had for 5. You satisfied the 5-year rule. Doesn't matter that you didn't satisfy it with the Roth 401k. That's one reason, by the way, I think even if you can't contribute to a Roth IRA because of your income, and you may have a Roth 401k, but you haven't left your job and so you can't take money out, is put a little bit of money in a traditional IRA, and this isn't even a backdoor Roth issue, even separate from that, and convert it into a Roth IRA, even if it's a small amount of money, just to get that 5-year clock running. Because once you've satisfied it, you satisfied it. Hope that makes sense. I am going to work on that video. Well, displaced Hoosier. Why am I having trouble saying Hoosier? I can tell you I've never had trouble saying Buckeye. Never. Any fund opinions on how a 25-year-old should invest a Roth IRA at Schwab? Well, sure. I think a 3-fund portfolio is great for just about anything. If you have multiple account types, you have some traditional, you have a 401k, Roth, I would tend to put equities in the Roth because I want it to grow as fat as possible. since it's all tax-free. But let's assume that you just have the Roth IRA. I think the 3-fund portfolio is the starting point. You can get fancier if you want. I do a little bit, but not much, and who knows if it really helps. I like the. Let's see, I go to YouTube. He's live. He looks like he's asleep. Anyway, 3-fund portfolio. I'm number 1. It could be because I'm logged in as me. Maybe they're like, oh, let's throw Rob a bone. Okay. Next question. Cal asks, any thoughts on what the average total return would be for an IRA in 2021? Oh, I have no clue. Invest in, right? Yeah, I mean, it just depends entirely on what you invest in. And not only what you invest in, but if you left it there the whole time, or if you were moving money in and out of different investments. I mean, the S&P is up like 25%, I think. Oh, you said 2022. No, 2021. S&P 500 2021 return, almost at the end of the year here. I thought it was around 25%. When was this written? Oh, this is November. Let's go to Slick Charts. Total return, oh, almost 30%, if this is accurate. I'm wondering if they could fit more ads on this page, possibly. We've got one up here, here, here. You can see I've been oh, this is Peloton. I'm not a Peloton person. See, it looks like I'm searching for gym equipment. Anyway, 2941. Actually, I did get some cool. I got a mace, it's a steel with a ball at the end. It's really cool. All right, but no, I have no idea. I don't know if there's any way to know, Cal, because you can invest in anything almost in an IRA. What kind of tea are you drinking this morning? Are you more of a tea drinker than a coffee drinker? Not really. I drink more coffee than tea. I drink my coffee black. This is Good Earth. Good Earth tea. Let me pull it up. I like it. Let's see here. Yeah, here it is. That's what I'm drinking. Sweet and spicy. I was going to say just like me, but that just seems wrong. So many levels. Okay. Craig, at what point does a 60-40 portfolio start to not make sense? If your portfolio is upwards of $10 million, does it really make good financial sense to have $4 million in bonds? So, Craig, that's a great question. And that gets back to my thinking on in setting the asset allocation. The point isn't 4 million. The question is, how long would that 4 million last you? In terms of expenses. And so if you spend 100 grand a year, it's going to last you 40 years. So I think a good argument could be made that you could go a lot more in stocks than 60-40. On the other hand, maybe you're a big spender and you're spending, 500 grand a year on a $10 million portfolio, which, it's 5%, make the argument. That's a different situation, even though it's the same amount of money and whatnot. I probably would be less inclined to go riskier. That's how I think about it. But, on the bright side, Craig, it's a really good problem to have. Okay. Ankit says, I want to invest for an objective which has an unknown time horizon. Although I guess this is an estimate, put in parentheses, 5 to 15 years. If investing monthly, what are your thoughts on large cap value index fund versus total market index fund? Well, we kind of had this discussion, but on the growth tilt, right? I mean, if I were to guess, I would say value will outperform growth over the next 5 to 15 years. The guess is not it's really based on nothing more than growth has outperformed over we'll call it the last decade, roughly. And equity prices are incredibly rich right now. and they're supported by both fiscal and monetary policy that is unprecedented, and at least in recent time, meaning the last 100 years, maybe ever. And when fiscal and monetary policy are less accommodative, which I think they have to become that eventually, I think value will probably do better than growth. And I could be wrong. So there you go. But that's my thinking. So I still, though, would not pick one or the other. Even though I believe what I just described, it's not like I have all value. I have a total blend stock market index fund. I tend to tilt towards value stocks. I bought some financial stocks, bank stocks. And I have some small cap value. But if I didn't have those, I would probably have some amount in, I'd maybe have 5 or 10% in a large cap value fund. Oh, another good one, actually. Let me just pull it up, see if it's still value. We've talked about this fund a lot, but I just want to look at it real quick and then I'll show it to you. I think it tilts towards value. Yeah, Schwab's U.S. Dividend Equity. I like that fund. I know a lot of you guys do too. So, I mean, you could certainly make the argument, put everything in this rather than an S&P 500, given where valuations are. It's just, you're definitely taking a gamble. How many stocks? Yeah, it's 100. It's got 100 holdings. It's so well diversified. The number doesn't make much difference. I mean, you can mirror the S&P 500 with 20 stocks, pretty close. Certainly with 100. I mean, that easily. Obviously, that's not what Schwab's doing, but I'm just saying 100 stocks is still pretty diversified. John, first, Happy New Year. Thank you. You changed NY Financial Life. Thanks. Well, I'm not sure what that means, but you're welcome. Second year of funding my Roth. I have bonds in my 403B. I have VTI and VXUS looking at 70-30. Do I need anything else? Well, I don't know, John. I mean, all that sounds reasonable to me, but I guess you have to be more specific with your question. If your question is, can a portfolio of VTI, VXUS, and then bonds constitute a reasonable portfolio? In my opinion, unquestionably, yes, it's a 3-fund portfolio. I mean, really, all you need like 3 things. You need diversity. You got that, right? There are thousands. I mean, thousands of equities, thousands, probably tens of thousands of bonds, depending on what you're in. So you got, and across value, growth, small, medium, large, international. I mean, you got diversity. You want, in my view, weighted towards stocks. I don't know what your allocation is. I mean, I know it's 70-30 VTI, VXUS, but I don't know what your bond allocation is. But, you want more stocks than bonds. I think for me, the lowest stock level you want is 50%, and that's in retirement. And for most retirees, I would think you'd want more than that. But so you want it weighted towards stocks and low cost. Those are the 3. It's not hard, right? And I don't know what your bonds are in, but VTI and VXUS certainly qualify as low cost. Mike says, thanks for the response. And he's the pink wig person. I'm trying to remember the question. I can't remember it. I brought that fund up because of the further he may be being small cap. Is he the small cap international question? I think so, maybe. I brought that fund up because of the further diversification by country, capitalization, overweighting per FAMA and French with a 10% allocation of the stocks. Yeah, I mean, if it's the small cap international, that was the question. Like he said, adding some of that is certainly a reasonable approach, seems to me. And by the way, who does that is Paul Merriman. His ultimate buy and hold, I'm pretty sure includes, I don't remember if that was a value fund, but I'm pretty sure it includes small cap value, international small cap value, and maybe international small cap. His buy and hold, the ultimate buy and hold, he tilts things towards small cap and value. Now he has large cap, and it's not all small cap and value, of course, but that's how he tilts that portfolio. And it's the rationale is pretty simple. History. That's it. Well, I think. I guess I've never asked him his rationale, but that's got to be it. I still haven't returned his phone call. Remember 2 weeks ago, if you were on if you watched the show, I mentioned he called me. I'm like the worst friend ever. If he emailed me, I'd have gotten right back to him. I got to respond. Okay. Michael Winter says GMO projects in its 7-year asset class forecast a minus 6.7% for US large. The only positive expected returns are for EM, emerging markets, based on the concept of reversion to the mean. What is your view on this? Well, they could be right. I have no idea. I mean, equities are expensive. Everything's expensive. Crypto, real estate, bonds, equity. It doesn't. I think the real question is, should this sort of thinking change our asset allocation, change the way we invest? For me, the answer is no. I just don't have confidence that I could change it at the right time and change it back at the right time. And I just think I'm better off living through it all, taking it on the chin and just not budging, not blinking. Ethan, I am squarely, he's not just in this, what I'm going to mention in a minute, he's squarely in it. In the 22% bracket and 30 years old. Thoughts on the Roth versus traditional at my age and tax rate? Well, so there would be other things to think about: state income tax, where you might live when you retire, your own personal view about future tax rates. But I think I would probably lean towards Roth, but at that tax bracket, it's probably a crapshoot. Yeah, that's my off-the-cuff thought on that. But I'd probably still lean towards Roth. Part of it too depends on future income. Do you expect your income to go up, to make more money, put more? One of the things, yeah, because ultimately you're thinking about what you're thinking about or trying to guess is what your taxes will look like when you actually start to spend this money. And you said you're in your 30s? Yeah, 30 years old. So, it's a guess at best, right? I mean, I'm not in my 30s. And I've been using new retirements software, which I like a lot, on the whole Roth conversion, which is sort of a similar issue, Ethan. Should I convert some to Roth? And let me show you this. It's fascinating, I think. I have to log out of my account. Remember, my mother-in-law could be watching, but that's okay. I have a demo account I can log into with fake data. Oh, I haven't put it in yet. Oh, can't show you this, can I? Well, I'll work on putting the fake data in for next week. This is what it looks like when you're starting to put it in. In any event, the point I was going to make was, they have Roth conversion tools, and whether you should convert or not, one of the big assumptions. So for their tool, they just assume the tax rates don't change, because what else? I mean, and I get that. What else are they going to assume? But you also have to assume or make a guess at what your traditional, what your RMD will be. Well, even at my age, it's a ways away. And what my RMD will be will depend on how much I have in traditional retirement accounts, which will in turn depend on how they perform over the next, in my case, we'll call it 20 years. Anyway, and so you can make those assumptions in new retirement. But when you change them, like changing the assumption from say a 9% average return to a 6% average return, the recommendations on Roth conversions change dramatically. So I guess the point of all that, Ethan, is you can only make a best guess. Some would say maybe split it up and do a little of both. If I were in the 22% tax bracket today, and contributing to a Roth IRA or to an IRA, I guess it could be a 401k, I would probably do Roth. And actually, I am contributing to a Roth 401k. I'm trying to think what my bracket is. I don't know. It's not far from that. It might be 24%. I don't know. Is there a 24% tax bracket? Like, I lose track of all this. It changes so often, or it seems to. For 2022, yeah, there's 22 and then 24. So I'll be somewhere in there, and I'm doing a Roth. But every situation is different. In my case, I've got enough traditional. I don't want any more. Mike says, have you noticed that VTSAX now has over 4,100 stocks within it? That is an increase of over 700 companies. Do you know why that change took place recently? I had not noticed. Take a look-see. By the way, that's VTI, same thing, it's the mutual fund version. Here it is. And where you find the number of stocks or bonds a fund holds, you put it into the quote page and you pull it up, and then you go to portfolio here, and then just scroll down. There it is. Let me see something. I don't know why. I guess my question to you would be, when did they add over 700, and why do you believe that to be true? I can look up and see if there's any news on it. But it's tracking, I'm pretty sure it's tracking the same index. But I guess I don't know. Double Dog Blitz. If I sell ETFs in an IRA and buy mutual funds, is there tax implications? Not to my knowledge, because you're in an IRA. You can buy and sell whatever you want. All right. So Vinyl says the RMD for inherited accounts is different from the RMD for your own account. Your lifespan is frozen based on the date you inherit. Okay, interesting. I didn't realize that. Well, don't they use the same? Well, they don't. The RMD, the regular RMDs have a table that obviously doesn't start. It starts when the RMDs start. Okay, I'll take your word on that. By the way, I've never calculated. Calculating an RMD is not hard, right? There's tables IRS has based on your age. It gets you a number. You divide that number into your balance, and there's your RMD. But brokers will do it for you, and they'll withhold taxes if you want. Now, in my case, the inherited IRA is really, really small, and the RMD is is obviously small, so it doesn't really affect anything. I buy a nice cup of tea with it, which is now cold. Okay. Claire says, I have a SEP IRA with Invesco, expense ratio 1.89% paren. I know, former advisor set up, close paren. So that's code for it. And so, Rob, I don't want to hear it from you about the 1.89%. I get it. I got it. Good. I won't say a thing about the 1.89%. I initiated a transfer into a traditional IRA with Fidelity, then get rebalanced with new securities. Thought. Sounds good to me. Well, so yeah, you're converting the SEP IRA to a traditional, I guess. Are you still contributing to a SEP IRA? I mean, you could set up a SEP at Fidelity. I assume they have SEP IRAs, but you're getting out of the 1.89%. I think that's a good thing. I guess I'm not sure what specifically your question is. Sounds like a good plan to me. I was just checking my text in case someone was saying, Rob, I'm watching you on YouTube and something awful's happening. Like the day my wife rushed in and said, they can't see or hear you. Or no, you couldn't hear me. Probably the best show ever. Someone with a 3-letter acronym for a name says, what's your view on factor investing? I got interested in factor investing because of the Rational Reminder podcast is using SCHD, which we just looked at, as a value tilt, a form of, I guess you could look at it as a form of factor investing. Yeah, value versus blend, size of the company, those are factors. So yeah, you could. I mean, in some way, we all do it, unless you're VT, and maybe you're probably tilting your portfolio in one way or another. Those that don't want international, you're tilting, right? You're tilting, which is okay, not a bad thing. Ethan, can you overfund an HSA? Yes, you can. It would be a bad thing to do, but you can. But keeping in mind, you could open up multiple HSA accounts and one doesn't know the other. I mean, like if you open up an HSA like through your employer, they're going to cut you off. And the same is true with at least most brokers that I've dealt with, whether it's an IRA or an HSA, they keep track of your contributions. When you make them, you indicate what's the year, the HSAs. Can you contribute to an HSA after the end of the year? For that year, I don't know. But with an IRA, you can. They track it for you. Anyway, I am 30 with $30,000 in mind. Based on some back of the napkin math, if I continue to max it, I will have I see. He's not talking about annual contributions. I will have $600,000 tax bomb. At 65, since it becomes a traditional IRA. I don't think that's how it works. Why do you think your HSA automatically becomes a traditional IRA at age 65? I mean, at age 65, you can take money out of an HSA for other than qualified medical expenses and not be penalized. You will be taxed. But unless there's some rule I don't know about, you don't have to take it out. Yeah. This is from the Motley Fool, and they can't be wrong. Unlike with flexible spending accounts, you do not have to spend money in an HSA in the same year you make the contribution. Fine. You also are not subject to the rules for required minimum distributions that apply to other types of pre-tax retirement savings accounts, such as 401ks and traditional IRAs. So unless I'm missing something, I don't think there would be a tax bomb. But, for those watching, if I've missed something, let me know. The great thing about the 457 is no 10% early retirement penalty before 59.5. I didn't know that. That is a big deal as you compare it to other retirement plans. Could be good or bad, right? I mean, one could look at the 10% penalty as a good way to, slap your hand if you're trying to get in there and take money out too soon. But yeah, I didn't know that about 457s. Thanks for sharing that, Mike. Vinyl, it comes in with a data point. In an article in Vanguard, it was said that they spend $1 billion a year on tech. If you're joining and you're like, what's the relevance to that? Fidelity apparently spends $2.5 billion. Harbor asks, I have investments across financial institutions. Any recommendation on tools to report all the funds in one place to review overall portfolio risk across investments? Well, I mean, to me, the number one tool is Personal Capital. And there's a link below the video. I'll sign into my demo account and show it to you, but I know longtime listeners have seen this many times. It's interesting. So as I was evaluating other brokers, let me pull this up on the screen. So this is a demo account. This is not my money. This is made up money. It's monopoly money. A lot of companies, brokers have their own tools. For example, if we go back to the brain and we go to Fidelity, they have, it's not loading. They have something called Full View. Let's see, here it is. And Full View allows you to aggregate all of your accounts in one place. including accounts held elsewhere. It's powered by eMoney Advisor, which is a tool used by advisors. It's not a great tool. I mean, Full View is fine with Fidelity. eMoney Advisors is not great really as a tool for you and me. In any event, I think if Personal Capital is free, you give them, your name, so they give this tool away for free. It's sort of a marketing thing, because what they do is they manage assets, and they'd love to manage your assets. It kind of seemed to come out wrong. In any event, and I've spoken to them. You don't have to. You can say no, thank you. You can use the tool whether you hire them or not. I've used it for years. But you can link. These are all manual, but you can link your accounts. It'll track all your dividends, income. You can link credit cards and bank accounts and track all your banking and your cash flow. You can link your home, and it'll pull in value via Zillow. But then, to your point, you can look at your holdings by either account or by individual holdings. You can drill down into your asset allocation, and on each of these, you can drill down further. You see all the different, and it breaks it down. If you pull into like large cap core, it not only shows you the amount, but which fund it's coming from. So these are all just different funds that I at various times have thrown into portfolios for this demo account. Of course, it tracks your performance. It also, I think everyone should do this unless you just know, but this retirement fee analyzer is great, because you set these assumptions, your date of birth, when you're going to retire, but then how much you're going to contribute, is there an employer match, your assumption on growth, any additional investment fees. I said I wouldn't mention it, but I'll just say you could put 1.89% in here. Whoops. There we go. Anyway, it shows you your weighted average fees, but then it also projects what that's really going to cost you over time. So that's probably the best tool. I think I really like New Retirement, but it won't do what you're asking. New Retirement, I usually just put in account balances. It doesn't give you asset allocation analysis, investment fee analysis. That's not its point. It's more for when you're retired or approaching retirement, and it'll track everything. You can factor in Medicare, Social Security, and it'll go through, basically map out a plan for your spending. A really good tool, but a very different and a big learning curve, but worth it in my view. Sarah, do you ever keep cash ready to invest in the event of a market dip or correction? Not really. I mean, my cash balance fluctuates a little bit, partly because of my business. So I can't say no to that, but I don't have like some plan where I've got this account sitting on the side and I'm just waiting to put it in at the opportune time. When I find an investment that I'm interested in, like the banks over the last year, I might start to accumulate a little bit of money with a plan to invest in it for a short period of time. But like in this point in time, do I have some cash that's on the side for just waiting to be invested? No. Oops. Let's lose it. Okay. Where did it go? Man, I need to catch up. You guys are way ahead of me. Where was Sarah's question? There she is. Okay, so that takes me here. From Dan. Maxing Roth IRA and traditional 401k for my spouse and I. We have a pension as well that should pay out roughly $60,000 per year each. That sounds pretty good to me. Should I just do all Roth? These questions. So meaning a Roth 401k instead of a traditional 401k? We're 27 and in the 24% tax bracket. Well, again, you need to think about state income tax, where you're going to live when you retire, your own personal views on the future tax rates. I think the 22 to 24% range, excluding state income tax for a moment, is kind of that, you could go either way. That's my view. That's probably not a very satisfying answer. It's not for me either. I've been struggling with whether I should do Roth conversions. I've kind of concluded probably not. And I'm in that same rough tax bracket somewhere, and I live in Virginia, which has, taxes, but not crazy. We don't plan to move, who knows? The problem with that question, Dan, or the thing we need to realize is there's really no tool that's going to answer it for you. If you're in an extreme situation, lowest tax bracket, you're going to make it more easy, to convert at least some of it. But when you get into these sort of questions where it's like you're somewhere in the middle, there's no easy answer. Like I said, I'm contributing to a Roth, but we already have more traditional than I don't need anymore. I think you could argue either. But you're doing a little bit of both. Honestly, I'd probably do the same thing if I were in that situation. So Jim says, is there a quick way, or what is the equation for getting average return on a portfolio? And he's got 2 IRAs, 2 Roths, 401k. Again, I don't try to do the math in a spreadsheet because there's too many. You'd have to track everything you buy, when you bought it, what you paid for it, all your dividends reinvested, all your interest reinvested in a bond fund. It's just way too much work. You can do it, and there are tools. You could track it like that on Stock Rover or Morningstar, or ShareSite was another one I was looking at. Personal Capital does it for me. So that's what I use. Scott, how do I convince my wife? I'm going to stop right there. I think you've already started off on the wrong foot. Okay, just kidding. How do I convince my wife, who has no risk tolerance, to invest her $300,000 portfolio into some Vanguard index funds, currently in a money market fund at Vanguard? Well, I don't know that I would try to convince her. Well, you could certainly show her how the different funds have performed over time. You could show her portfolio visualizer. I can tell you my wife would have zero patience for me showing her portfolio visualizer. It would not work. One thing might be, not all or nothing, maybe a little bit. Can we start off with just a little bit? Put your toe in the water. I don't know. But it's important that, $300,000 in a money market fund, that could be that's not, depending on your situation, not great. Sarah, Paul Merriman Ultimate Buy and Hold versus GL Collins One Fund for Life versus Rick Ferri 4-fund portfolio. If you were 30 with $1 million in cash, not planning to touch it for 30 years. Probably Rick Ferri. Well, I don't know what his 4-fund is. It's actually, I think, in Portfolio Visualizer, isn't it? Yeah, here it is. We'll pull it up. So it's total stock market is half of it. He's got 8%. This is real estate, right? Yep. 24% in international, and of those three, I'd probably do Rick Ferri. Although if I were 30 or I have 30 years, I'd prefer 10% in bonds. But they're all reasonable approaches, so that's probably what I would go with. But I wouldn't go with any of those. But if I had to choose, probably Rick's. Because I would add small cap and emerging markets. Depending on the fund, there's emerging markets, so I should say I would add more. Because there's small cap and there's emerging markets in the funds we looked at, just in smaller amounts. Are there reasons to move the 401k? You decide the tax withholding when pulling out, eliminate the Roth 401k RMD, and eliminate any small fees. Mike, I confess I don't understand that question. Kathy, when rebalancing a portfolio, which tax lots should you sell from an ETF? The cheapest or most expensive tax lots? Well, if you, so depending on which ones you sell, it depends, right? If it's a tax year where you're not going to pay any capital gains tax because your income and capital gains are low enough, I'd want to sell the ones that have the most unrealized gains, right? I mean, at least up to that point. Or if, maybe I'm in the lower capital gains rate, 15%. Is there a 10%? Let's look it up. No, there's not. So, maybe if I mean, you're a big hitter if you're in the 20% bracket. Well, that's single. You're even bigger. I mean, 500 grand. So, but if you're still, let's say you're married, filing jointly, and you've got some room in here. Remember, ordinary income fills that up first. So if you have 80 grand in ordinary income, that gets filled in first. So you're not going to get the 0%. It's automatically going to push you into the 15%. So you just have to remember how ordinary income and capital gains work together. But if someone was in here, I'd want to pull out. But short of that, I generally want to keep my tax liability lower. That's been my approach. Nalish says, Morningstar recently had an article regarding tax efficiency funds. Can you please explain how that works? Well, I haven't read the article. And I'll see if I can find it. Well, they had one, Morningstar's top fund picks for taxable portfolios. So, I mean, different funds generate different yearly taxes depending on what they invest in, how active they trade, do they generate capital gains. You take an extreme example, a REIT generates usually a lot of income that's taxed as ordinary income. In contrast, some funds, you take a muni fund, for example, where you don't have certain taxes that you have to pay, federal income tax. And you might not have state income tax, depends on where you live in the fund or the muni that you're invested in. So I generally in my taxable account do try to get tax efficient funds, but Vanguard index funds, are fairly tax efficient. They don't generate capital gains because they haven't in a long, long time. And they pay a dividend or interest, but those have both been relatively low, as we all know. Tax efficiency has to do with one, what they're investing in, and their approach to investing. Because you could have funds that generate a lot of capital gains that get distributed to you in December, by the way. So some of you may be feeling this, even if you haven't sold any shares. So just another reason that index funds generally, on an after-fee, after-tax basis, do so much better than active funds. Again, that's it's a generalization, but I'll see if I can find the article, and if I have anything to add to that, I don't know if that's the article or not, but I can circle back to that issue maybe next week. Part of it, I hope I don't sound dismissive. For me, it's like, I just get low cost index funds and it's pretty efficient. I don't know, it's pretty simple. Oh, it looks like Mary has a question and Mike tagged me, so that's good. I'm 57 and have all my retirement in the market, mostly S&P 500. I'm comfortable with that. What's your opinion? Well, the first question would be, when do you plan to retire? You're 57. Retiring at 60 is a lot different than retiring at 70. For me, at 57, personally, I would be more comfortable at about 80-20, roughly. So not having all of my money in stocks, let alone the S&P 500. I personally would be uncomfortable with that, particularly given valuations right now. David, do you have any opinion on the buy, borrow, die strategy? I can't see how it's useful to me. So for those that are wondering what in the world that is, so let's say you've got a lot of assets, and you could sell them for spending, right? Think this is sort of a strategy for the really wealthy, whatever that is. I don't know, 10 million, 100 million, whatever your number, whatever. Rather than selling those assets and triggering capital gains, right? They'll just borrow, and they'll use the assets to secure the loan. And there are, places to do. Schwab is probably the place that a lot of people go. They have what they call pledged asset line of credit, and it's interest only, and you basically can keep it in forever. And so they'll borrow, they'll pay that interest on it, but live off the borrowing. And if you have enough money and what you need to borrow to live on is small relative to your wealth, you can do that for a really long time. And there may be periods where you pay it off with some funds potentially, but the thought being is that what happens when you die, you get stepped up basis, your beneficiaries do, on the assets that you leave them. And so you basically avoid the taxes. I mean, I can imagine that it makes sense in some cases, but for the vast majority of people, it doesn't. And the one thing I've never been able to wrap my mind around is eventually, if you're paying interest only and you're borrowing every year, unless the amount you're borrowing is really small compared to what you have, eventually it's going to catch up with you. I mean, assuming, you do it for 10, 20, 30, I mean, at some point, don't you become like the US government, just completely indebted? And then what happens when rates go up? I mean, it's fine now. I think Schwab's lowest rate's like 1.9%, and you might even be able to do better than that. But I mean, what happens when rates are 5%? So I have I'm skeptical, but maybe I'm just not smart enough. I can't believe it's almost 1:00. Man, there's a lot of questions. I promised last week I'd go through all the questions that I didn't answer, and I'm still going to do that. I'm going to do some more videos, like, not live Q&A, but just individual videos on topics that seem to come up a lot, and I will do that. But man, I'm not even close. I'll do a few more. Ugh. Sarah wants to know how an 18-year-old in college should invest $1,000 to $2,000. Assuming long-term investing, I kind of think the way we talk about it. I mean, $1,000 to $2,000, you might put it in the total stock market. You could do a 3-fund portfolio. It's easy enough, but I'd probably just, if I were in that situation, I'd probably just at that level just put it in one fund. I don't know what I'd pick. If I were doing it today, I would probably take a look at the Schwab dividend fund for that kind of money under the circumstances, maybe. But it would have to be long term, right? Because it could lose money for sure. Any opinions on Schwab's intelligent portfolio for hands-off investor? Yeah, I don't like it. I would definitely go with the Betterment or Wealthfront over Schwab intelligent portfolios. And I think they're free, right? I think they're free. I should say, I think Schwab's intelligent portfolios are free. Betterment and Wealthfront are not. But see, I've been looking at this. You guys are asking me questions on things I've been studying. There's no. Let's see here. Let's take a deeper dive and let's see what happens. Nothing happens. Well, I can just tell you the problem. Why is that not working? I want to refresh. I don't know why that's not working. Try it over here. Show you here we can see it here. It's this right here, cash. See that right there? They force you to leave at a minimum 6% of the portfolio in cash. And that's so like here it's 23% in cash. I don't know if you can see that right there. Make it a little bigger. But even if you go aggressive, it's 6%. Hang on, there we go. It's 6% in cash. And that's where they make their money, right? They're making money off that cash. And I just don't, I don't know. I just don't like that. Betterment and Wealthfront are 25 bips. I suppose you could do the math and decide which one's more or less expensive, but I just don't like having this forced on me. So I would choose Betterment or Wealthfront, and I think they're both good. One of the things Betterment's done recently is they have what's called flexible portfolios, because before you had the choice between like what your stock bond mix would be, but within that they picked the funds and you really had no say in it. And two of the things they didn't have, commodities and REITs. I don't feel strongly about commodities, but I kind of miss REITs. They have the reasons for it. Wealthfront does use REITs. Obviously, you wouldn't use REITs in a taxable account. But in any event, Betterment now allows you to add them and change the percentages. You have a lot more control over your portfolio. And I kind of think, it seems so simple. Why don't all the brokers have that? And it should be, frankly, I think it should be free. Yeah, there you go. So Have Fun wants to know if the yearly limit on I-bond contributions is per calendar year, or do you have to wait 365 days? I am reasonably confident that it's calendar year. By the way, if you go in and try to buy some more bonds on January 2nd and they don't let you, then I guess I was wrong, but I'm pretty sure it's calendar year. Mary, I think I answered Mary's question. Yes, but you tagged me in your second question. Thank you. I know I've gone over. I'm going to do. How many people are still on this? Is anyone even listening? 210. Okay, people are still here. All right. What is your view? This is from John. What is your view on doing a backdoor Roth contribution next week in light of the delay of Build Back Better legislation? Also, will Ohio State win the Rose Bowl? Well, the first question is, will they even play it? I would think they're favored over Utah, but I think anything can happen. Ohio State, they have it's a very talented team, but it's a young team. And I don't really know a thing about Utah, although I know they have a good team. I think they've lost 3 games this year. I think I remember seeing that. Ohio State's lost 2. Sad. Yeah, I would do a backdoor Roth if it makes sense for you. Why not? Oh, would you do it next week? Meaning in 2022? Well, that's interesting. Can they make restrictions on a backdoor Roth retroactive? I would think that would not be doable. What would happen to all the people that have done backdoor Roths? I would think. One thing you could look at is if the Build Back Better plan, whether it says whether that aspect of the plan will be retroactive. I think some of the tax issues were going to be retroactive, which I don't think, just fundamentally, I don't agree with that, but no one asked me. So, okay. So Paul says, I know you've talked about value funds. Can you go over what to look for in a value fund? Mostly interested in Fidelity, as that is where my Roth is. Well, I would still generally stick with an index fund. And the way they work is they come up with some criteria to define what a value stock is. So they could use price to earnings, price to sales, price to book, and then they're but and I say there are indexes that do this. So if we go to Fidelity X value funds, let's see what we get. I'll pull this up on the screen. I have no idea if this is I'm going to guess this is not an index fund. Why? Because of the expense ratio. So let me jump back for a second. Oh, here we go. So this is an index fund. Well, it tells us right here, but also the expense ratio is a lot lower. It's 35. 3.5 basis points. And I don't know a thing about this fund, but so you notice it's got a large weighting to financials because they're in the sort of the value space, but of course it has a lot of other things as well. It's all domestic. You get to see their top 10. These are pretty common, players at large value or companies. This is probably reasonable, a good place to start your evaluation anyway. Like I said, I've not, other than literally pulling it up right now, I've not looked at this, but probably a good place to start. VLCOX, you come over here. Did I mistype it? Well, FL, did I say VL? I always get my F's and V's mixed up. That's got to be some sort of issue. By the way, you notice it's a 3-star and think, well, I don't want a 3. Who wants a 3-star fund? I want a 5-star fund. Well, most index funds by definition are 3-star because it's all based on returns. The star rating for Morningstar is, I think, pointless. So yeah, you can get a sense of it, how it's tilt to value here, and it's PE. You could compare this to an S&P 500 and get a sense. S&P 500 is going to be closer to 20, I think. Let's do, we'll just do VU. But it'll give you a comparison. 4 versus the Fidelity Value Fund is 232. Price to sales 190 versus 275. The yields will be higher on value. This is 147. This yield is 203. So that's how I would think about it. That's sort of at a very high level, just what I'd think about. But again, the nice thing about index funds is you just kind of have to know what it's covering. If you're going to do actively manage, you got to do a lot more homework. Hari says, any thoughts, concerns on using only I bonds in my bond allocation? Well, again, you've got the practicalities. 10,000 a year, you're limited. You can't pull the money out for a year. Penalty if you pull it out within 5 years. But I own I bonds. I just bought some for me and my wife. I'm going to buy some more in January, unless it's 365-day rule. I don't think it is. Again, if you need more than 10 grand a year, it's just not practical. You'd just be better off with tips. And one person even asked me the other day, why even bother with I bonds? Just do tips, and it's reasonable. I like I bonds. I can't help it. 7%. It's kind of hard to pass up. Of course, it only lasts for 6 months, but given the current inflation, who knows what the next adjustable rate's going to be? I don't think the fixed rate's going to change, but. Kathy says, and I'm going to make this my last one. I'm tired. And I will go through them though. I'm going to be doing my goal I'm going to try to do at least 2 other videos a week and maybe 3 a week. We'll see in the month of January, in addition to the live Q&A, but don't hold me to it. I'll do my best. I want to purchase a home in the next year. I liquidated an annuity and transferred it to Fidelity. I reserved a good portion to cash for down payment. What do you think? I mean, if you're buying in the next year, I'd keep it in cash. Which sounds like what you did. That's what I would do. A bond fund can go down, even short term. A 1 or 2 year duration fund can go down. The only question I would have, you've got it at Fidelity. Could you make a little bit of interest in a high yield savings account? Because Fidelity has great cash management accounts. Like if you're going to spend it, you're in retirement, you need a spending account. But they don't they don't pay much. Trying to find where. Here we go. Here's why is it doing that? I don't want that. Well, you'll just have to take my word for it. I'm having trouble getting to the right page. Unless you've got an account that I don't know about that pays some interest, but depending on the amount, you're going to get 60 bips from 61 bips from Axos or whatever, 40 or 50 basis points from somewhere else for a few months or up to a year, it may not be worth moving the money. It depends on how much it is. But in terms of putting it in some kind of cash account, I mean, that's what I would do. All right. I just, this last question, Brandon, can you speak about time management? Well, I'm 10 minutes over, so I'm not sure I'm the person to talk about time management. I'm not sure, Brandon. What do you want to know? It's kind of a broad question. I don't know how well I manage my time, but I'm kind of out of the workforce. I do my own thing. It's easy for me. I don't know. I'll give it some thought for next week. All right, gang. I will look at all the questions I didn't get to, which is just an amazing number. I mean, literally, if I answered all these, I bet you I could keep going for hours. Can't do it. Tired. But thank you for joining. It means a lot to me not to be speaking into a camera, by myself. Your questions are great. And I will go through after the stream and read the rest of them and try to organize them in some fashion and address them in upcoming videos as best as I can. And I will have timestamps, as I said, below this video at some point, hopefully today, but by tomorrow at the latest. So there you go. Well, thanks for joining. Hope you have a great week. Good and happy New Year. Watch the Buckeyes. You don't have to. And until next time, remember, the best thing money can buy is financial freedom. Do you get tired of hearing that? I don't get tired of saying it. Not one bit. All right.